Well, thank you. Good morning. Senior Deputy Governor Wilkins and I are happy to be here with you again to answer your questions about today's interest rate announcement and our latest monetary policy report. So I'd like to begin with a few remarks around the issues that were most important to the Governing Council's deliberations. Well, since our last MPR in April, global economic developments have been quite disappointing. These have led to a significant downgrade of our estimate of Canadian economic growth for 2015. There were three factors behind this downgrade. The first, Canadian oil producers have lowered their long-term outlook for global oil prices and have cut their plans for investment spending significantly more than previously announced. Second, China's economy is undergoing a structural transition to slower domestic-driven growth, which is reducing Canadian exports of a range of other commodities. And third, Canada's non-resource exports have also faltered in recent months. While this is partly due to the first quarter setback in the U.S. economy, it's still a puzzle that merits further study. Compte tenu de la chute des cours pétroliers et la baisse d'autres produits hors énergie clés, l'économie suit maintenant deux profils de croissance différents, le profil des ressources et le profil hors ressources. Ces profils ne sont pas indépendants. L'annulation d'un investissement dans le secteur pétrolier aura souvent un effet négatif sur le secteur de la fabrication, par exemple. Mais nous pouvons montrer la situation à l'aide de décomposition sommaire. I draw your attention to Chart 18 on page 19 of the MPR. There we can see the sharp drop in oil and gas output, which constitutes about 10% of our economy, and the slowdown in non-energy commodity production, which represents a further 8% of our economy. Now, to give you an idea of the size of the contraction in the oil and gas sector, late last year, that sector was growing at close to 3%, and now it is running at minus 7%. Now, the remaining 82% of our economy is seeing steady growth of just over 2%, although this represents a moderation compared to last year due to the setback in the U.S. and spillovers from the resource sector. But as the new non-resource track regains momentum, it is expected to become the dominant trend at the aggregate level. Now, we expected this to begin in the second quarter, but it didn't, because of the three factors that I listed above. A major shift in the country's terms of trade is one of the most complex situations that an economic forecaster can face. We've said from the very beginning that while there would be both negative and positive effects from lower oil prices on Canada, the negative effects would dominate and they would come first. The positives would be more gradual, taking the form of stronger consumer spending, both here and in the U.S., and increased non-resource exports because of a stronger U.S. and a lower Canadian dollar. Ces effets positifs ont été longs à se manifester, mais on peut les voir à l'œuvre. Les sous-secteurs des exportations qui sont normalement sensibles au mouvement du taux de change ont affiché une meilleure tenue que les autres. Les retombées sur l'économie américaine semblent avoir été en grande partie temporaires, car le marché du travail aux États-Unis a été solide. Dans le secteur hors ressources de l'économie canadienne, la tenue du marché du travail a été bonne. Et, selon nos conversations avec les entreprises, les contraintes de capacité augmentent. Cela implique une hausse probable de l'investissement ainsi que des gains au chapitre de l'emploi dans les prochains mois. Bref, on s'attend à ce que ces tendances positives commencent à contrebalancer les effets négatifs exercés par le secteur des ressources au cours des prochains mois. These considerations figured prominently in the Governing Council's deliberations because the state of total demand in the economy relative to our production capacity is what drives our inflation outlook. The economy has been operating below full capacity for some time, which is why we estimate that the underlying trend in inflation is running at around 1.5 to 1.7%. Core inflation is higher than the underlying trend because a decline in the dollar is raising the prices of imports. Total inflation is much lower because of past declines in fuel prices. But as the temporary effects dissipate, all of these measures of inflation will converge on the underlying trend. The weak economic performance in the first half of this year means that Canada has more excess capacity, which is increasing the downward pressure on the underlying trend in inflation. To put it in the language of our risk management framework, the three factors that I mentioned earlier moved us out of the neutral zone to a place where the downside risk to future inflation is material. This would imply a slower return to full economic capacity and sustainable 2% inflation. En même temps, les risques entourant la stabilité financière restent élevés, notamment les vulnérabilités liées à l'endettement des ménages et la hausse des prix des maisons. Et nous devons reconnaître le fait que la décision d'aujourd'hui pourrait aggraver ces vulnérabilités. However, as we noted in our financial system review, financial vulnerabilities would usually translate into full-blown risks with attendant consequences for the economy only if there was a trigger, such as a widespread and sharp decline in economic activity and employment. The terms of trade shock that we are experiencing, which has already translated into an excess capacity increase and downward pressure on inflation, has the potential to act as such a trigger if left unaddressed. Accordingly, the Governing Council agreed that acting at this time was consistent both with the bank's primary mission, which is the pursuit of its inflation target, as well as helping to manage financial stability risks, even if there could be some increase in financial vulnerabilities in the process. So let me remind you that monetary policy operates with a long lag, and there are many transmission channels through which interest rate changes affect the economy, including longer-term bond yields and the exchange rate. This needs to be taken into account when predicting how the economy will respond to our actions and when. It also makes it difficult to pin down the precise timing when Canada will reach full capacity with inflation sustainably at target. It could just as easily be sooner as later than projected. And let me also remind you that there are many uncertain elements and risks to our outlook, which are discussed in full in the MPR. But one additional element I could mention is the prospect of interest rate liftoff in the U.S. Although we have no special insight into when this might occur, we have said many times that it would be welcome, for it would be consistent with a more positive outlook for the U.S. economy. Nevertheless, because the Canadian economy is dealing with a large terms of trade shock, it is likely to be less synchronized with the U.S. economy than in the past. Furthermore, we would expect any rises in global bond yields to be at least partly imported into Canada, with possible implications for the Canadian dollar and with an uncertain net effect on our economy. To conclude, the Canadian economy is undergoing a significant and complex adjustment, even while it is still trying to overcome persistent global headwinds. In the judgment of the Governing Council, today's action is required to help facilitate the adjustment of the economy to this unusual situation. And with that, Carolyn and I would now be happy to take your questions.
First question, Richard Mann, CTV.
Hi, Governor, just looking at your first and second quarters, in your view, was Canada in recession?
Well, it's clear that in the first quarter, the data showed a contraction in the economy, and the monitoring that we have for the second quarter also shows a small contraction. So that means that the economy did have a mild contraction in the first half. I'm not going to engage in the debate about what we actually call this, because Those terms are very finely determined. It's not a casual or mechanical system which decides, what we classify things. Usually well after the thing happens that you actually can make these decisions. But there's no doubt that we have worked our way through a mild contraction. What I want to focus on is, as I said in my opening remarks, the other 80% of the economy, which appears to be growing quite well, generating new jobs, generating incomes, growing in excess of 2%, around 2.3%, and very likely to accelerate as these other things come together. Certainly the U.S. economy does appear to be gathering more momentum, and so we're quite confident that the export side will resume its growth track, which we saw in the latter half of 2014, and then it faltered during the winter months. So all those things together, along with the action that we've taken today, makes us quite confident as we look into the second half of the year. But it'll probably take until the latter quarter of the year, the fourth quarter of the year, before we get growth above potential, which is what's necessary to begin closing the output gap through time.
So by cutting rates today, we'll inevitably pour gasoline on the housing market and consumer debt. So does this stimulus help go to the wrong places?
Well, there are a lot of mixed views on this. Certainly, interest rate relief can play a lot of different roles for different households. I was just reading a survey this morning that said a lot of households are reacting to the possibility of lower rates and saying they would use that as an opportunity to reduce their indebtedness, not increase it. And those are people who have already perhaps bought a house and bought a car, and they have an opportunity to reduce their indebtedness, or maybe they've done a renovation on their house and borrowed for this. Whatever it is, they've already spent that and are looking for opportunities to pay it back. But usually when we cut interest rates, we envision someone who's got a longer-term plan to buy a house or to buy a car. And what happens is when the interest rate goes lower, it helps them make that decision sooner. And that purchase then stimulates economic growth. And of course, it adds to that individual or that household's debt, but it's a household without any debt to start with. And so it's a question in my mind whether that rise in overall debt for the economy is somehow not sustainable or less sustainable than the old level. So, in fact, in general, this is how the economy grows. And so the other side of it is companies, because the investment decision is something that we all take for granted will begin to happen when there's enough demand from exports. And but making those credit conditions as fluid as possible also facilitates that decision. And we know the corporate sector has a very low level of debt. So pouring, as you put it, you put it in, I suppose, the most negative way you could. We admit that these conditions are likely to cause financial imbalances in the large sense to edge higher. But that is one of the things we took into account when making this decision. That in fact, the primary mission and the best contribution that we can make to getting things back to a more normal setting is to address the shock that the economy is going through.
Next question, Leah Snur, Reuters.
Morning. After the rate cut in January, you said that you had taken out the right amount of insurance. Did you get it wrong, and should you have cut rates again sooner?
Well, looking in the rearview mirror, I suppose that's the sort of arithmetic one could do. But given what we knew at each point in time, I think not. What has happened is the facts have changed quite quickly, actually, in the last 2 to 3 months. As one of the big shocks in this outlook is the downgrade of investment intentions by companies in the oil patch. So we don't look in a magic database or use a special model to get that. It's not that hard to just ask them. And so we had a pretty uniform assessment around that back at the beginning of the year that they would be cutting around 30% in investment. In the background of that was a presumption, I think, on the part of many that the oil price would only be temporarily really weak and that it would recover sometime later in this year. And I think that those expectations have been dampened down over the last few months for a variety of reasons, not least of which is just the passage of time without it happening. And so what is happening is they're beginning to cancel or postpone much longer range project work. And that means around a 40% cut this year in spending by those companies, which is a very big change. They're responsible for around a third of Canada's overall investment. So very disproportionate to the size they represent of GDP and the economy. Their investment share is huge. So that's the biggest thing. The other thing is we were quite surprised that after the weather improved, we thought exports, the U.S. economy was improving and that our exports, non-energy exports, would improve, and that failed to happen. And so those are our two major pieces of information. We certainly didn't know those things. So, I think in real time, all that was right. The difference perhaps in January was that we really didn't know the size of the oil price shock. It was still moving. And so that was our reason for using the term insurance, because we couldn't really assess just how much fallout we might be facing, and therefore we just knew the direction. So.
Your base case scenario has non-energy exports, the weakness being temporary, but you also call that weakness puzzling. How can you be sure that it's temporary if it's not completely clear what's going on?
Well, we don't, it's not that we can't explain it at all. There's a little part of it that we can't explain, and the part that we can explain is obviously related to the temporary setback in the U.S. economy. So part of that is a really important assumption that the U.S. economy is coming back, but I think it's well supported by the data flow that we're seeing. The part that remains is a bit of a puzzle, and as you know, this is a segment that we've studied very hard over the last 18 months or so. We were feeling pretty comfortable last year and into just, say, towards the end, by the end of 2014, we were feeling quite comfortable that all the things that we thought would recover had started to. And then we have the data mixed up with this weather effect, the U.S. setback, et cetera, so it's hard to read in the last couple of months. So it's possible it will sort itself out just with more data, but we'll be looking at it really hard in the meantime. Do you have anything extra to add to that, Carolyn?
Yeah, sure, Governor. I think when you look at the non-energy export category and the areas that we thought would lead the recovery, we have been disappointed, as the Governor said, and of course the U.S. and the weakness plays into that, as does some other special things. For example, other commodity exports that are outside the energy have been a bit weaker than we expected. Of course, part of that's because of weakness in some of these prices. So, for example, base metal prices. There's also the other categories that are unrelated to commodities at all that seem to be weak. Now, the bright spot that we see, because that was part of your question, is, well, why do we see this recovering? Well, part of it is because we see the U.S. recovery. We also see the effects of past appreciation in the Canadian dollar having an effect that you would largely expect. And so if you isolate the exports that are typically very sensitive to exchange rate movements, you can see that those exports in the non-energy sector are actually still doing quite well. They've lost a bit of momentum, but they're doing quite well, and they're up year over year as an example. And so when you put those things together, you can see that the combination of, the dollar plus the pickup in the U.S., that this should pick up in Q3 and continue to do so throughout the projection horizon.
Gord, next question, Gord Eisfeld of Financial Post.
All right. Given the fact that we're down to 25 basis points now, and the Fed is still eyeing an increase, perhaps in September, we're going in different directions. Is the monetary policy run out of steam in Canada? Is there anything else that can be done using monetary policy?
Well, I think we still have a fair bit of room to maneuver and other tools in our toolkit. our expectation is that they're not necessary, that we've got things figured out at this stage. The oil price shock, of course, has more potential in it. So that's, and of course, the world has ways of surprising us over and over. So we do have to remain ready. But I think the main thing is that, as I said in my opening remarks, that Canada and the U.S. economies would be less correlated than usual because we have this extra shock. I mean, they have a terms of trade shock, but it's actually the opposite direction for them. And there's a chart which shows that clearly in the MPR, how the economies, in some sense, will diverge. And so it's reasonable to expect a divergence for some time anyway between our policies. And that's why we have policy independence. That's why we have a flexible exchange rate. It's for precisely these reasons, that those adjustment channels remain available to us. So, but right now, feeling pretty comfortable. What we've seen and how we see things coming out over the next few months, we should get some better readings and feel even more comfortable like that U.S. recovery shows up, and we can see good consumption numbers from Canada. So all the cylinders should be moving at the same time.
Can I ask that if that doesn't happen, do you actually have room to go to zero?
Well, clearly, if we are disappointed in one way or another, then we have room to move, and as I said, we have other tools in the toolkit that we can appeal to. I think an important thing here is that we don't look at a change in rates as just that 25 basis point thing, but rather how does it work its way through other financial markets. So if people are revising their view on what the bank would be doing based on this outlook, then they change their entire profile of interest rates over the next year or two as they take that into account. And in the models of the economy, just as in the real world, people think, well, now they're making my plans, I can look ahead and make those kind of decisions as a business, so the CFO has a better idea of what interest rates might be like a year or 2 years from now through the yield curve. And so it's that plus the exchange rate effect and of course the stock market and so on that all matter to this transmission mechanism. So right now, a lot of those things, those responses are uncertain things to us. So if today the exchange rate is below our assumption, partly in response to what we've done today. And so when other things are equal, a lower currency will be a bit of stimulus to the economy, which means that then it has the potential of offsetting any other shocks that may come along. So any new shock would need to be reassessed in the entirety. So we can't think of this as a mechanical process.
Prochaine question, David Aiken, Post Media Network.
My family can't wait to vacation in the U.S. for the next couple of weeks, and thank you very much for making that a lot more expensive vacation with this particular rate cut. Nonetheless, I want to ask you about some fiscal policy issues, and I know you got to comment on what the government's doing, but you are clearly, it seems to me, the bank's clearly worried about a contracting economy and is doing what it can with its tools to inflate the economy. So let me start with this first question. The government says $3 billion is going to Canadian families next Monday. Is that going to be stimulated? Would that help from their side of things?
Yes, it certainly is a factor in our look, as we always do. We simply take fiscal policy as a given. So back in our last update in April, it was prior to the budget, and so now what you have in there is this universal child credit benefit, UCCB. Is commencing next week with, this next week with backdating and so on, and then that shows up, we believe, as a noticeable bump in consumption spending during the third quarter. So it's part of that transition that we talked about. It's not the only thing. I think it raises consumption by about a percentage point under an assumption that not all the money gets spent, but some fraction, half or something like this. But the point is, it's a significant thing to our outlook. Of course, underneath all that too is a continuing infrastructure program. So there is a persistent effect which is monitored in the fiscal and in the investment line. Well, I guess that's it. I mean, I don't know what else to say except that it makes a contribution to growth in our outlook.
And again, just given all the signaling and everything you said today in the MPR, that again our economy is in a bit of recession. We're about to have an election campaign. We're in an election campaign where the incumbent government says we're going to have a balanced budget. You just cut your growth forecast for this year by half of what the budget said. We can't possibly be balancing a budget, everything staying equal then, it seems to me. Would you like to see policymakers, politicians, maybe take a little more frank accounting of current economic conditions, given that it seems to be important that we improve economic conditions in Canada, and that's what the bank is trying to do?
Well, I simply won't comment on fiscal plans or in any way for obvious reasons. We have tools at our disposal, and we're working with them. I would just say that it is a complex bit of arithmetic to figure out what a downgrade in the economy does to a fiscal plan, because it depends on where the downgrades are. As I've just showed you, it's in about 10% of the economy, and it's in places which have a different fiscal impact than if it were generalized. So that's an important thing to take into account when thinking about those things. But that's just something that we would do as forecasters as opposed to the fiscal authority, which must look at it in a variety of ways.
Thank you. Next question, the gentleman in gray next to Leah.
Oui, question pour vous relancer un petit peu là-dessus. Est-ce que davantage de mesures de stimulation économique de la part du gouvernement, moins d'austérité, plutôt qu'un budget équilibré, est-ce que ça aurait aidé davantage l'économie canadienne? Si vous regardez un petit peu ce qui s'est fait au cours des derniers mois, est-ce que ça aurait été souhaitable?
Je ne dois pas faire un commentaire sur la situation budgétaire. Ce n'est vraiment pas notre domaine. Mais c'est évident que dans ces prévisions, il y a une influence de la situation budgétaire, ça augmente la croissance. Mais c'est juste une partie de notre prévision, c'est tout. Je n'ai aucun commentaire sur ça.
Sur la question de la récession, c'est pas un mot que vous voulez utiliser aujourd'hui?
Je ne veux pas engager dans ce débat concernant le nombre pour cette période. C'est évident que l'économie a vu une contraction modeste, très modeste, mais une contraction dans la deuxième moitié. Certainement, le deuxième trimestre est juste une prévision pour le moment. Le premier trimestre, nous avons les données peuvent être révisées, mais peu importe, c'est une contraction. Et la chose la plus importante, c'est que 80% de l'économie a une croissance plus que 2%. Ça, c'est le cœur de l'économie. Alors, c'est la partie qui va accélérer dans les prochains mois. Ça, c'est la chose la plus importante pour nous.
Prochaine question, Rudy Lecourt, la presse.
Bonjour.
Rudy.
Vous faites pas de prévision sur le cours du dollar canadien. Vous faites plutôt on peut comprendre l'enjeu, mais vous faites quand même l'hypothèse qu'au cours des 2 prochaines années, votre scénario économique est basé sur un dollar canadien à 80 cents américains. À chaque fois que la Banque du Canada a baissé son taux directeur, il y a quand même eu une baisse du dollar canadien. Alors, cette fois-ci, ça devrait être aussi la même chose. Ça, chaque fois qu'il y a une baisse du dollar canadien, ça signifie qu'il y a des pressions inflationnistes. Vous dites dans le rapport sur la politique monétaire qu'il y a au moins un demi-point de pourcentage de l'inflation actuelle qui est nourrie par les biens importés à cause de la faiblesse du dollar canadien. Est-ce que la décision actuelle n'est pas susceptible de renforcer l'inflation au-delà de votre scénario, puisque votre scénario, lui, considère que le dollar est à 80 cents et que, par conséquent, l'inflation arrive à 2 % bien avant 2017, comme vous le prévoyez?
Ben, c'est une question très complexe, mais pour commencer, l'influence du dollar canadien sur l'économie dépend du contexte. Si, par exemple, il y a une diminution du prix du pétrole, habituellement, on voit aussi une diminution du dollar canadien. Et ça a un effet beaucoup différent à l'économie, en combinaison. Au lieu de situation où c'est juste le mouvement du dollar, par exemple. Parce que la baisse du prix du pétrole, c'est une baisse déflationniste et ça va diminuer le taux de croissance de l'économie, etc., comme le choc qu'on analyse en ce moment. Alors, c'est impossible pour nous de simplement prévoir le dollar dans les contextes multiples. Et on utilise une assumption. C'est juste une convention. Mais chaque fois que le dollar change, on peut analyser cette combinaison et avoir un avis de l'influence nette sur l'économie et sur l'inflation. Pour le moment, ça indique, oui, il y a une partie de l'inflation qui est due à cet effet, mais c'est quelque chose de temporaire dans notre prévision parce que le dollar reste stable dans la prévision. Mais si la situation change, il faudra le mettre à date. Veux-tu ajouter quelque chose?
Non, je pense que vous l'avez bien couvert.
OK, merci.
Mais en sous-question, ça sous-tend quand même qu'une baisse du dollar canadien va nourrir encore l'inflation, peut-être au-delà de ce que vous avez prévu dans le rapport sur la politique monétaire.
Oui. Vas-y.
Si jamais, c'est sûr, dans le contexte tout en étant égal, c'est sûr qu'une baisse du dollar aurait un effet temporaire, transitoire, positif sur le taux d'inflation et on tiendrait ça en compte. L'effet net dépend de la source de la baisse du dollar. Dans le contexte actuel, on a une hypothèse de 80 sous. Et combien le dollar va changer dans les prochains mois vont dépendre de beaucoup de facteurs et on va le regarder de près, mais on ne peut absolument pas les prévoir.
Next question, Greg Bunnell, Business News Network.
Governor, I'm seeing that TD Bank has followed fairly quickly on your heels this time. They waited last time, but they're only going down 10 basis points. If the other banks follow suit, that means since the beginning of the year, you've brought down your rate 50 basis points. Bay Street's only gone down 25 basis points. That's where the lending's happening in the economy. That disconnect has to be troubling.
Well, that's how financial markets work, and that is, as I said before, the transmission mechanism of monetary policy goes through a lot of different channels, and that's only one. So when a consumer looks at what they might have to pay for a mortgage, say a month from now or 2 months from now, they would have the chance to look through various maturities. They can look at the floating rate, which is tied to prime. They can go into the bank, and the bank will say, yeah, that's the posted rate. I can give you a quarter point off of that, et cetera. So consumer borrowing rates can be much more highly correlated with our actions than that particular rate. So it's more like a blend of various rates that are available to people, and different people choose different avenues. Similarly for firms. And what's happening to bond markets and so on matter just as much as what we do. And it's precisely why I mentioned in the opening remarks that, some of those things could happen without our doing. So like early this year, lots of central banks were cutting interest rates, and so bond yield and the Europe was going through QE and so on. So we had lower rates across the board, which were not attributable, at least not entirely, to what we had done. So just like the dollar, as Rudy was just asking, those things move around for other reasons. And so all we're trying to do is have an influence on it as opposed to determine it. And if this ensures that credit channels remain wide open for both households and firms, then we've done our job. And in a lot of cases, as we talked earlier, people who are on floating rate mortgages, they get relief immediately. And it's a question of what do they do with this.
Quickly, I wanted to ask you, you mentioned a couple times earlier the questions that you have other tools. Obviously, you still have a bit of wiggle room in terms of rates, but when you talk about tools, unconventional measures, south of the border, it was QE. Are those among your tools?
Yes. So the bank posted a paper describing these tools back in soon after the global financial crisis. I guess it was 2009, and that basket of tools hasn't really changed through time, except that we've had a lot of other central banks actually test them out. So through that period, you've had the process of learning in the profession about how they actually work, whether they're effective, in what ways are they effective. For us, forward guidance is usually the next sort of place, and what you're doing in forward guidance is, as I was describing earlier, you're trying to influence not today's interest rate, but how interest rates are perceived through the yield curve, so that you're affecting the profile of expectations for interest rates, and that leads to more financial stimulus than you otherwise would have with a normally shaped yield curve. So the bank, of course, did use some forward guidance in the past. We've said that when we would normally use it would be in unusual times or at the zero lower bound. So that's the sort of thing which is in the toolkit. Yes, unconventional in the broad sense. That's what I mean. It's in the toolkit.
Kim Mackerel, Wall Street Journal.
Hi, thank you for doing this. I'm wondering if you can speak to whether there are lessons from Canada's experience with low oil prices right now about the risk of relying very heavily on a single commodity in the economy.
Well, as a first principle, it's natural to think of economic diversification in an economy as a good thing. But it's not something that someone like with your portfolio that you say, I need to diversify my portfolio, so I'm going to have some of this, some of this, and some of this. An economy is actually driven more by its natural endowments and how it reacts to the global situation. So when oil prices went from 10, 12 years ago, they were $25 and they went over $100, it would be quite odd for a free market economy not to respond to that in putting more effort, more resources into producing more oil and earning a lot more income because of it. And so we said, for example, at the peak, there was like a 7% increase for the entire country in income from that shift that happened. And now about half of that increase has been eroded by the situation we face now, and it's, of course, that economic fallout that we're working with. So that's to say, if you could avoid having to work it off if you never did it in the first place, which I think is an odd kind of way to think of the economy would, of course, react to that pricing, make intelligent investments, produce the stuff. Companies know what they're doing. It's real money. It's not something that's just a kind of a game or anything like that. This is real money that they're working with, and so they make best decisions they can, knowing what they know when they know it. And so I think it's a little bit of a false trail to try and somehow manage diversification. It's more a case of the economy determines its own state of diversification. And frankly, Canada is a highly diversified economy. And some people, I think, are a little surprised by the small size of the oil and gas sector, relative to the whole economy, which is why we're putting emphasis on Chart 18 to remind people that we have a big and diversified and otherwise growing economy. So I hope that's answered your question. I'm sort of a little bit wandering around. Do you want to add anything? Because
I would just add that one of the features of if you have an economy that's subject to terms of trade shocks, then what's really important, you asked about a lesson, is that you have the mechanisms that allow labor mobility, because people need to move from from places where there are jobs to places where there are not jobs. And that process takes time, but the more flexible your labor markets are, the faster that will occur, the more productive it is. And when you look at our employment data and the statistics and migration data, you can see that those channels are working right now, and that's a positive thing.
Thank you. And just to follow up quickly, you spoke about the tools that you, that you have available to you in dealing with the tools that you have available apart from the rate decision specifically. And I just wanted to ask you to speak to what the challenges or the limits are in terms of dealing with problems in an economy that may be driven by a single sector. Are there limits to the ability of monetary policy to actually address that?
Well, I think maybe where you're going is the nature of a shock which is causing the economy to adjust structurally is what we're talking about, as Carolyn was just referring to. So you basically need an internal reallocation of resources from one sector to the other as the growth shifts. So like from 2002 to till last year, we had a two-track economy too. I'm talking about two tracks today, but we had two tracks, and the top track was the energy track. And now you get this reversal. And so people and companies were investing more, and people were moving into the energy sector and getting good jobs and so on. And now some of that will probably reverse. And like Carolyn says, when you got fluidity, it helps. Well, that type of shock also has the aggregate demand effect that we're fussed about, which is that the economy is growing more slowly. And so our tools are able to help with part of it, which is to help cushion the aggregate blow to the economy. But the ability of the economy to adapt to those new circumstances depends on that fluidity and other things, which Canada seems to do reasonably well. That's my appreciation of the last 10 years, is that we actually were pretty fluid. We adjusted well to it, and I expect to see similarly a pretty good adjustment now. And it's probably why we are seeing the better job numbers in the non-commodity, non-resource economy, because matching is happening, and that's happening. So all that to say that our interest rate cut today can provide an environment in which that kind of adjustment is a little bit easier, but we can't just use a magic bullet to offset it all. Whereas if it was a simpler shock, let's say you've just had a recession out in the world and our economy slowed down, you know, it's kind of an across-the-board situation, and then our tools are more capable of adjusting the whole thing. But it's the internal adjustment which makes it complex, hence the word complex in our press release in here. It is a contribution we can make to facilitating that adjustment, but we can't prevent it or make it unnecessary, if you like.
Greg Quinn, Bloomberg News.
Economists and investors were basically evenly split on what would happen today, whether you would cut rates or not. Was it a close decision in the deliberations?
I wouldn't describe it as a close decision. It's more of it's a decision where we had a number of trade-offs on the table. So it was a decision which was, I'd say it's sufficiently complex that it requires a lot of deliberation and a lot of inputs. It's not a mechanical decision, not even close. And of course, prominently in that is exactly the questions that have been raised. How much of an effect would you be having on financial stability issues or the concerns around vulnerabilities that we discuss in the FSR? And so that was, as I said in my opening remarks, those were the preoccupations. How big of a shock do we face? Is it temporary or permanent? Those are the economist things always. How much uncertainty is it in there, or how much do we actually know, or do we have to wait and see? All those kinds of things, but the financial stability thing then comes in front and center, and that requires us doing that complex set of trade-offs. So ultimately, as I said, we believe that the primary mission takes precedence in this situation. and hence the reaction, and that yes, there is some risk that financial vulnerabilities will edge higher as a consequence, but that they're manageable within the context, especially if we do get the economy back home a little sooner than it otherwise would. That's good for financial stability.
Part of the mystery of exports is the lower dollar was supposed to provide a pretty strong benefit. I think it's fallen by more than 10% over the last 12 months. Is the dollar not working in helping exporters? Does it need to fall more to make us competitive again?
Oh, no, on the contrary, there's a chart in the MPR which shows chart 24? Chart 24, which shows the decomposition of exports between what we consider to be historically exchange rate sensitive and historically less exchange rate sensitive. And there's a really big difference between those two tracks, which suggests the dollar has been having an effect for quite some time. And that chart only shows goods. It's important that about 15% of exports are services, which are also very highly exchange rate sensitive because you have almost no foreign inputs, if you know what I mean. So like if you had a lot of imported inputs into your operation and you were exporting, you could have almost a naturally hedged situation, which is like a globalized firm. In which case, the exchange rate causes you to have like more expensive inputs, but allows you to sell more output. So those two things are kind of a wash for a company that would be naturally hedged. But in a services situation, your inputs are primarily people, domestic workers, and so it's almost all Canadian input. And so when the dollar moves, you have substantial exchange rate effect. So take tourism, for instance. So someone asked me, he's going to the States and it's going to cost him more. But if you just walk around and ask folks at the office, what are they doing on their summer vacation? There's a lot more people that are saying, well, this year we're going to PEI or we're going to BC or we're whatever. And people from outside are coming here to do that too. Try and get yourself a room somewhere in PEI this summer. It's going to be a good year. So those kinds of things those add up to exchange rate effects on exports and therefore on economic growth.
Next, Tom Perry, CBC.
You talked about the child care checks going out and infrastructure projects. I'm wondering, is there other additional stimulus beyond monetary policy that would help improve the economy right now?
Well, as we've laid it out here, we see the economy achieving a velocity which is in excess of potential later this year, and therefore beginning to close the output gap at a reasonable pace. That's slightly delayed from what we had before. We were late 2016 before, now it's going into 2017, but frankly the gap, as we estimated, is actually really small by then. So it's not a really big difference in timing, but mechanically it is slightly later. So that suggests that the economy has what it takes to get back where it belongs with sustainable inflation at the 2% target. That would be after the exchange rate effects dissipate and the gap dissipates, so underlying trend in inflation creeps up to 2%. And so I think that that's a full package. If there were any other changes, shocks, they would, like if there was another oil price shock, we'd have to contemplate that. If there were a fiscal shock, we'd have to fold that in and figure out how to change the trajectory. But we take those things as givens, not for us to predict or make a comment on.
I'm just wondering, because it all sounds still very tentative, and I'm wondering if further stimulus on the part of the government would firm things up a bit more.
Well, as in your textbook, it tells you whether or not fiscal policy firms up the economy. I mean, but that's a very complex question from the fiscal authority's viewpoint. So, for me, it's not a question for the bank.
Next, Les Whittington, Toronto Star.
Hi.
Just quickly, in terms of clarifying things, I'm not questioning whether or not, what kind of terminology you want to use today, but the usual definition, at least as far as people like us are concerned, of a recession is 2 consecutive quarters of negative economic growth. Would you question that definition, or would you say we shouldn't be using that kind of definition?
I just find the discussion quite unhelpful. If you do a little reading on what the NBER does or what StatsCan does to figure out how to describe the history of the economy, it's a lot more complicated than the rule that you lay out. That's the minimalist kind of mechanical kind of rule, and it's especially unhelpful when what has happened to the economy is very narrowly defined. It's in, as I said before, about 10% of the economy. So if it were across the board, you would have a different conversation. But since it isn't, we won't. So I think that what we need to focus on is where are the fundamentals positive? Well, their fundamentals are positive and gathering pace in about 80% of the economy. That's the important part of the story for monetary policy, and it should be the important part for the general public.
Right. I want to ask you about the paragraph where you talk about financial stability in your statement. As I read it, what you're saying is we have to take some more risks to financial stability to avoid greater risks to financial stability. Is that essentially what you're saying?
Yeah, there's an important distinction here, though, as we were very careful in the FSR, and I was careful there, to say that when we analyze those things in the FSR, we're talking about vulnerabilities. And it's the old parable about a big old tree that has a crack in it. That makes it vulnerable. Is it a risky tree? Well, only if there's a trigger that causes that branch to fall on your neighbor's house. And so when we analyze household indebtedness and housing markets in particular in the FSR, we talk about those things as vulnerabilities. So if you have a lot of debt and you're servicing it, no problem, that's great. But when you lose your job, then it becomes a risk to you and therefore to the economy. So what we say here is that there's a possibility that this cut in interest rates will add to those vulnerabilities, measured in some way. I argued before that it's not necessarily a clear case, that maybe the households that borrow at this lower rate are those that don't have any debt today, so they're just as stable as the one next door. And that's usually the way we think of it. And so it's simply not a mechanical thing that we're trying to say there, but of course, by cutting rates, we are taking a risk that those vulnerabilities could edge higher. And that means if there were a trigger someday, there'd be a higher chance that there'd be a problem for the economy as people adjusted to it. However, what we have right in front of us is a potential trigger, which is the oil price decline and its fallout on the economy. And so by addressing that, we are addressing the trigger part while taking a bit of a chance that there may be some edging higher of the vulnerabilities. And we think getting the economy back to full capacity with more people with jobs, et cetera, is the most important way of making financial stability risks more manageable. Does that help you?
Sure, thanks.
Okay.
I'd like to pose a question, sir. I wonder if you can give us a sense of to what extent events in Greece have caused a slowdown in the Canadian economy, uncertainty in Greece.
Well, the situation in Greece is obviously a really delicate one, and it's been troubling to watch it happen as we went along. But except in the sense that it may contribute to the general aura of global uncertainty, potential uncertainties around, how Europe is dealing with things and how the European economy might respond, et cetera. Those uncertainties can touch decision-making in any country. So that's why we would keep an eye on it, and it's why it was named as one of the potential risks in our FSR, but in the last FSR, we downgraded the importance of it, not because we thought it was getting less likely, but that Europe was in a stronger place to handle it. And so all I can say is that you can no doubt find someone in business who would say that matters quite a bit to my business, and so it's important, and it's important from a global situation point of view, and symbolically important, obviously. But if you got down and asked what are the actual mechanical linkages, they're pretty small, especially in the financial system.
And slowing growth in China, the same?
Well, slowing growth in China is more significant in this way I just described, and it was number 2 in my list of 3 things that have caused us to downgrade our outlook compared to what we had before. And the way that's working is that even China appears to be moderating, although today's numbers came out reasonably close, I guess, to around 7% growth, which was everyone's hope, let's say their hope, as opposed to their expectations. So maybe a little bit better than expected. But anyway, around what we're expecting. And with that, but what is happening is they're going through a structural transformation, which will mean a stronger domestic sourced economy, more services, and less construction and some material growth. And so that has put a bit of a damper on a variety of commodity markets that are important to Canada. So commodity prices, non-oil, like metals in particular, have been drifting down. And in Canada, we're getting a response of lower production levels in response to those lower prices, and therefore lower value and volume of exports. And so that's one of the reasons why our exports, non-energy exports, have been underperforming. So it's now become part of the shock, and it's why we started to talk today about the resource economy versus the non-resource economy, as opposed to the energy economy and the non-energy economy. Because in between is some resource sectors that are actually being hit by this slowdown. So China is, and you can't just say it's China, but China kind of is the leading light in the emerging world growth cycle. But Brazil has been in a significant slowdown for a while now. So the 2 big players in that space that are struggling with their growth track.
Thank you. Next question, Gerhard Brown.
No.
Oh, no?
Because I wanted to ask Greece, and you asked this question.
Okay.
Stole his question.
Moderator's privilege. Yeah. I think next, Dean McRoby, Politics.
If the Chinese stock slump or slide continues, would you expect capital to come out of the Vancouver and Toronto housing markets in a panic, or flood into those markets in a panic?
Well, that's quite the either-or question. I have to pick answer A or answer B. Is that I mean, the answer C is I don't know. I mean, the more important thing, I suppose, is that financial volatility like that can have consequences for economic sentiment and the economy itself, which is the more direct, linkage to Canada. How it may affect Chinese investors into Canada, I won't speculate.
Next question, Elena Cherney of Wall Street Journal.
I'm curious about this export puzzle that we keep talking about and going back to. You have explained that some of the factors in that lag in recovery are well understood, but there are others that are not so well understood, and you mentioned that it's a puzzle that merits further study. How do you go about understanding that, better understanding that? What kind of indicators, what kind of people do you talk to? What will the bank do, or what is the bank probably already doing to better understand this critical missing piece of the puzzle?
Yeah, well, we're already talking to everybody. That's what the BOSS process is about, and not just the firms that are represented in BOSS, but many other firms. So let's put a check mark beside that. But a year ago, we went through incredible detail down to the over 2,000 category level, and to figure out in which subsectors we had. Excuse me, I'm pretty well out of water, but I'm sure the boss is going to bring me some. So there were something like 500 of those categories where exports had fallen from reasonable levels. Like this started in around the early 2000s, this analysis. So it wasn't due to the financial crisis, but a longer term trend. So about 500 of those categories simply stopped exporting. And so we were able to trace that back to, oh, thank you very much, Steve. You can have this one if you like. Sorry. Trace that back to media reports on companies that had actually closed or moved offshore. So when we went to the part that was remaining, and we thought, yeah, then we could comb through that and figure out which parts are normally well correlated with the investment cycle in the U.S. And because it was the investment part of the U.S. recovery that had just barely begun, and we thought that was one reason why they'd been lackluster. And sure enough, as we got through 2014, they started to really show their stuff. So we had this chart, well, it's in here again, updated. So it looked really good. And so we were getting quite encouraged, actually, right up until the wintertime. And so what happened, of course, the U.S. economy had this stall out first quarter, and part of it is the port strike, part of it is the weather, part of it may be fundamental. So we don't know anything. We don't know that yet. So that's when I say we can explain it, it's kind of rough and ready. We can attribute some of this, but a bunch of it we can't, and so that opens up a broader range of questions, like you know, when a Canadian company that has operations in Canada, the U.S., and Mexico, and there are lots of those, as well as other countries, when demand from the U.S. starts to go up, do they automatically beef up the Canadian operation, or do they find it more less expensive or more efficient or whatever, or is it, you know, does it happen from the U.S. installation or does it happen from Mexico? That's a simple example. So we know that there are companies like that. So we need to perhaps dig down a little more into those 2,000, or well, the less than 2,000, but anyway, 1,500 categories, and try to understand them a bit better. So what we're doing in our forecast is we're being very conservative about making up this lost ground. This is the lesson we learned back in 2013. We were assuming we'd make up the lost ground, and we reverted to, let's assume we don't make up this lost ground until we do. And so that meant that we had to take a longer time to get back to full capacity. That was back in 2013. It's all part of this story. So in a way, it's another chapter in a story we've been telling for some time, and I don't have anything except right now it would be nice if the data as they came in, they kind of fix themselves up, and then you'd think, oh, okay, it's primarily a hangover from the first quarter, weather effects, that kind of thing. I give you an example, like, of course, in the inshore fishery in Atlantic Canada, well, stuff was frozen a lot longer than normal. So, you know, like I was there in the long weekend in May in PEI, and there was still snow and stuff, you know, and so everything was slowed down a lot. So the weather didn't suddenly turn great just because it was, you know, the end of the first quarter. And some of it could be permanent and yet temporary at the same time. So if during the really bad weather people ate in restaurants in the U.S. a lot less than normal, and therefore, and they couldn't get mussels or clams or things from PEI anyway, well, they don't eat out twice as much in the second quarter to make up for it. And so you kind of have this potential for a permanent thing, but then it becomes temporary because it kind of goes away with the season. So we'll have to sort it out. That's just speculative. It gives you something to think about. If you get some good ideas, let me know.
And that does it for today. Thank you very much.
Thanks very much.